Welcome back to part 4 of this book about the psychology of money, the final part. Let's crack on and tell you about investing. The key thing is knowing about your own game plan. What are your goals and how long are you planning on investing for? If you're thinking of a 10-year investment, for example, you'd be looking at a company thinking, could the management execute their vision? Also, what's the potential for that industry over the next decade? If you're thinking about 1 year, then you'd be maybe thinking, well, what are the current product cycles? How is that performing? Are we in a bear market or not? If you're just doing this as a day trader, you perhaps don't care for those things. Really, you're just thinking, can I squeeze some cash out of this between now and the end of the day? Because there's this iron rule of finance, and that is money chases returns to the greatest extent that it can. And you have to bear that in mind when you're listening to two investors speaking. One may think there's a poor investment. The other may look at the same investment from a different lens and think this is a great investment. Because of the fact that money is chasing returns, that actually explains how financial bubbles can occur. And it's not that people are irrationally investing. They're rationally investing, but they're doing so aiming to get more return. And the momentum keeps going up and going on until it just gets to a size that it pops. And sadly, we're seeing that quite a lot with speculation, day case trading in cryptocurrency. Be aware in general, when you're hearing about reports, people tend to pay more attention to negativity than to positivity. And the media will often have a negativity bias. That's one of the reasons why I would personally try and avoid newspapers. But if you look back into history, when flight was invented by the Wright brothers, they were barely covered. Whereas if one bright spark says that the stock market's going to crash, that would get onto the headlines. So, what you're aiming for is some room for error, flexibility, and also financial independence when you're trying to build your wealth. I'll digress slightly and come back to money, and that's about Daniel Kahneman, the psychologist and award-winning economist. And he mentioned that when planning, we tend to focus on what we want to do and can do and neglect the plans and skills of others whose decisions might affect our outcome. And the true is, that's true for explaining both what happened in the past and predicting what happens in the future. We focus on this kind of causal role of skill and neglect luck. Now, why that's relevant to money is in business, and in particular startup businesses, they will think that they can do this and then they'll work hard on it and an outcome will be achieved, often omitting the potential impact of unknown unknowns like COVID pandemic or just what other firms are actually doing. So everyone without exception really will sadly face an unknown in terms of a financial hit. And because of the very definition, nobody will expect it. Therefore, it's critical to start saving now. Let me tell you a bit about how to build wealth. And it's really regarding your ego and your wealth. Because ego and wealth are linked. And really, you're aiming to have less ego and more wealth. Because saving money is really the gap between your ego and your income. And wealth is what you don't see, because wealth is actually created by suppressing what you could have today in order to potentially have more stuff or more options in the future. And if you can suppress your ego and build your wealth, it actually can take a burden off yourself, because in society today you'll have all heard of keeping up with the Joneses. But if you can comfortably live below your means without that desire to get more stuff, then actually you can build a tremendous amount of wealth and also have that pressure off yourself by keeping up with others. Hope you found that helpful, and I'll see you next time.